This week in crypto didn't start with crypto headlines. It started with geopolitical moves, banking applications, regulatory warnings, and institutional filings. And that tells us something important. As we move deeper into 2026, crypto continues shifting from a speculative asset class into financial infrastructure, shaped less by rumors and more by real systems, markets, and policy. If you want to understand what actually changed, then this week matters. Story 1. Geopolitics and the price signal. The most immediate signal came from a geopolitical event, not a crypto announcement. After the US captured Venezuelan President Nicolas Maduro and his wife in a coordinated operation, global markets reacted quickly. Risk assets, commodities, and currencies all saw adjustments. Bitcoin and broader crypto followed. Bitcoin traded above $90,000 as traders priced in a mix of geopolitical uncertainty and liquidity assumptions. This isn't because crypto is directly tied to Venezuela. It's because crypto now sits within the same macro ecosystem as other global assets, where geopolitical shocks influence how investors think about risk, liquidity, and alternatives. For years, the question was whether crypto could decouple from the macro system. The more accurate question today is how deeply crypto is becoming integrated into it. Story 2. The trust bank moment. The second development was quieter, but arguably more structural. A Trump-linked financial group submitted an application to US regulators to create a national trust bank specifically designed to issue, custody, and manage stablecoins. If approved, this expands stablecoins from crypto products to regulated financial instruments sitting inside the US banking perimeter. There have been experiments around custody and tokenization before. But a trust bank built around stablecoin issuance is different. It implies a future where dollar-backed crypto rails operate alongside traditional banking infrastructure, not outside it. This is how financial infrastructure gets modernized, not through replacement, but through integration. Story 3. ETFs and TradFi competition. Institutional behavior continued this theme. Morgan Stanley filed to launch new crypto ETFs, joining a competitive field that already includes major banks and asset managers. ETF filings sound routine, almost boring, until you consider the structural implications. ETFs are how traditional capital allocators gain regulated exposure to crypto without custody burdens, audit concerns, or operational risk. Every ETF filing is a signal that crypto is being treated as an investable financial product, rather than a speculative arcade. And it reinforces a pattern that's been building since 2024. Institutions are not asking whether to participate in crypto. They're negotiating how. Story 4. Risk and consumer protection pressure. While institutions were integrating, regulators were focusing on risk. The FBI released data showing that Bitcoin ATM fraud hit a record $333 million last year, driven largely by social engineering scams. At the same time, India's tax authorities publicly warned against broader retail crypto adoption, citing systemic risk and regulatory uncertainty. Two different countries, two different approaches, one shared theme. If crypto is going to scale globally, consumer protection and financial safeguards will become mandatory, not optional. Infrastructure without risk controls does not scale, and regulators know it. Story 5. Behavioral finance in real time. There was also a behavioral angle this week. A trader in India turned a geopolitical prediction into a 1,233% gain by positioning ahead of the Venezuela capture news. It's a small example, but it illustrates a much larger trend. Crypto markets increasingly reflect real-world information flows, not just speculative hype cycles. Prediction markets, geopolitics, liquidity, and macro data are becoming intertwined. The crypto markets of 2026 no longer only respond to crypto narratives. They respond to global systems. Connecting the dots. What actually matters? If you step back from price and headlines, here's what this week showed. Geopolitical shocks can shift market sentiment. Traditional banking is moving toward regulated stablecoin issuance. Institutional capital is building ETF exposure pathways. Regulators are addressing consumer protection and systemic risk. And markets are responding to real-world information, not just crypto news. This isn't the bull phase of crypto adoption. It's the structural phase. A phase where infrastructure, policy, settlement, and risk management determine which parts of the crypto ecosystem survive and which become irrelevant. Ending. What to watch next? Going into next week, there are 3 pressure points worth watching. Geopolitical risk. Does Venezuela's situation escalate or stabilize? Institutional filings. Do ETF and trust bank applications accelerate? Regulatory tone. Does consumer protection tighten or loosen? Those variables will tell you more about crypto's trajectory than any short-term price move. If you want coverage focused on signal over noise, this series is built for that. And the story of crypto in 2026 is only just beginning.